For a closer look at what to do next with this market, which continues its rally, S&P flat, holding its gains, let's bring in Morgan Stanley Wealth Management's Lisa Shalett and Northwestern Mutual Wealth Management's Brent Schutte. Welcome to both of you. Lisa, I read your note that you sent clients. You sound a little cautious about chasing this rally. Why?
Absolutely. And I think the reason is that increasingly the index itself is not representative of the economy and the data that we're seeing. So we are, very enthusiastic about the economic recovery and the V shape that we are seeing in manufacturing, in housing, as we saw in, some of the supply chain related parts of the economy that are doing well and are reflected in improving PMI numbers. But that's not what the market is. Today, this index is all about this work from home, technology, everything is digitized, everything is internet. And we believe that disconnect is just getting too big. So while we do love the bull market narrative of an economy with a V-shaped recovery and, massive stimulus both from the Fed and the federal government, we think the way to play that is through individual stocks who are actually going to benefit from the change in the data. It's not entirely clear to me that, blowout home sales are going to sell new iPhones. Everyone who wants an iPhone or an iPad got one back in March. And so, we do think that there is
Lisa,
rotation that needs to happen.
Which types of stocks? You're talking about value? Are you getting into value stocks?
We're talking about cyclical sectors. We're talking about small and mid caps. We're talking about value-oriented sectors. So we're buying financials, we're buying industrials, we're buying transports, we're buying parts of the healthcare value chain. We're buying, various parts of consumer discretionary that have been left behind, all of which we think are linked to housing. So we've got lots of things to buy. They're just not those, largest cap, mega tech, work from home names.
Hey, Lisa, Sarah mentioned Citi's new target. One of their lines is that despite the euphoric sentiment, equities continue to advance. We see shades of 99, Tobias writes, but the Fed started tightening then, and there's no hint of a repeat now. Would you go that far?
Yes, so I agree with Tobias's the spirit of what he's saying, certainly. But exuberance is exuberance nonetheless, and we know what it looks like, and we know it doesn't end well. And so anyone who's going to jump in here needs to actually have a strategy for what is it that's going to get them out of the market, because we know that at some point these things catalyze and break when you're this disconnected. So while I can't, talk about, specific stocks, let's just say, it's hard to fathom, the idea that, one of the world's largest, electronic car makers can, increase their market cap 50% in 16 trading days and that not be labeled irrational. And so I just think liquidity goes a long way until it doesn't. Stimulus goes a long way until it doesn't. And I think that, folks who are just chasing here really need to look at that consumer data that you guys just reported. The expectations, we got to remember the U.S. economy is 60 to 70% a consumption-oriented economy. And if consumer confidence is flagging as much as those numbers suggest, it's going to be very hard for this market to run simply on fumes and sentiment. And so I think that folks who are chasing here need to have a strategy for what is the catalyst to get you out, because, it's not, the policymakers aren't going to tell you when.